This is the boardroom. We set this up really, again, as a kind of this internal need that we saw. We had people asking us, sometimes similar questions, but in general, they wanted a place for community of other investors, especially other passive investors, where it just felt like a community where they could ask questions without feeling awkward, let's say. We tend to attract, other business owners or industry leaders that are looking to invest in real estate. And this forum is really trying to cater towards that environment, right? It's like we want to talk about all things investing in real estate. We also talk about all, more generic level, but still specific to the community is that building wealth mentality and protecting it. We plan on having guest speakers, even panelists in the future. And then another part that we're really keen on, especially as a business and as an individual myself, just this idea of fueling generosity. We will have some discussions on that in the future. If you're curious about what that means, because we haven't talked about it yet, you can shoot me an email or jump on a call. I'm happy to talk about how we're doing that today. We'll start off with a quote. The single greatest edge an investor can have is a long-term orientation. And I think that's more true today than it's really ever been, especially in the environment that we're in. But today's topic is really about, we call it the capital stack in investing, and we'll get into what that is. But really, it's that idea that you need to understand where you're at in line. Yeah. And what the capital stack is it really is an illustration of what capital's in front of you and what capital's behind you, right? If someone's going to get paid, what order are they going to get paid in? So this idea of a payout line, when money comes in, who's it going to first and who's it going to last, makes an impact, right? And sometimes it makes an impact in the investing decisions we're making. Sometimes it also makes an impact in deals that we're already in. And I have an example of specifically that last part we'll talk about towards the end. But in general, it makes a difference, let's say, right? And for some people more than others, depending on what investments that they're in today and perhaps what they're looking for next. So quick illustration, and I posted at least the illustration out on LinkedIn earlier today, but in general, when you think of capital stack, just think of like a hierarchy. Yeah. There's people that are at the base, right? And we'll go into who that is. These are people that are getting paid first. And I kind of think of it as if there's money pouring into the system, right? Who's collecting that money first? And then, as that fills up, who's getting it next? But it's that idea of hierarchy, right? From different financial sources, whether that's debt, whether it's some preferred equity partner, institutional money, and money from, let's say, common equity like investors and so on. Where do they sit in line, and who's the most secure and who's the least secure? And typically, let's say the bottom of the stack, if you will, is the most secure. They also expect the lesser return, right? Whereas people at the top of the stack, which are typically investors, they should expect higher returns. They're taking on more risk because they're also getting paid last. Yeah. And this will all make a lot of sense, and we'll go through an example as well. So the most common example that we see in large majority of syndications is just this, right? You have some type of senior debt or mortgage against a property, right? So in general, maybe rewind a bit for people that are less familiar with like a syndication. So in general, a syndication comes in as entity, yeah, and in that entity you have active members, sometimes called the GP, sometimes called the sponsor. And then you have passive members, the investors, often called limited partners. And all together, we purchase an asset, yeah? And that asset has debt against it. We also raise a bunch of capital from ourselves and our investors to go in there. And then out of that investment, we get paid, profits, right? So if we're buying an apartment building, it's paying out income. It also has equity. So when we go to sell that property in the future, that equity is coming back to, again, that whole entity, including the passive investors and the sponsors. Now, when we talk capital stack, it's really looking at, let's say, where money's going in that project, right? So as an example, I mentioned senior debt, like mortgage, they're getting the money first, right? They're first in line. If money's coming in, they're getting paid, right? The next person in line is the investors. And that's the most common. Yeah. And normally it's like a 70-30 split or an 80-20. And I'm not talking split within the syndication. I'm talking the portion of capital that is going against the project. Yeah. So if you have a 70%, loan to value on your mortgage, most of your capital is stuck within that debt, and they are first in line, right? For good reasons, right? That's why they have a lien on the property, right? They're going to get paid, and then everybody else is going to get paid. Now, because they have that secure position, and I think this is an easy concept for most people to get, right? This is not blowing over anybody's shoulders, but it's important to understand for the next element that we're going to talk about, right? Because they're in that secure position, they're also getting the least returns, right? So a few years ago, those returns may have been like 3%. Now they're getting up in the 7-8% range in some cases. In some cases, depending on the type of debt, even higher. But in general, they're in a secure position. They also are expecting a lower return, right? Whereas the investors would expect a much higher return. Oftentimes, people are targeting that 14 to 18% annualized return type of range for we call common equity. So the next piece I would talk about, right? So if you look at the total capital required for a deal, right? You got to buy the property, you got to do renovations and all this stuff, right? All of that is the total capital. Senior debt or limitations within what you can get at a given time. Sometimes there's additional debt that will come in called mezzanine debt. And really the easiest way to think about it is a second loan position. Yeah, so that's the easiest, way to get our head around it. It's really just a second loan position, and it's second only to that primary mortgage or that primary debt. It's in a little bit better position. A lot of times they're getting a better return than, let's say, the senior debt lender, right? Because they are taking a little bit bigger risk. They're also overall, the reason people would do this is if they wanted to boost the returns for the investors, right? Because if you think about it, if you're making the same number, the same dollar value in your returns or in your income, and you've invested less capital to get those returns, then on a percentage basis, you're getting a much higher return on your investment, right? And so some people will push that leverage, right, with a second loan or even the primary loan, whichever, and they'll push that leverage a little higher, perhaps with mezzanine debt, to get better returns for the top of the capital stack, that being the investors, right? Because they now have less money in the deal, but because they have less money with the same level return, their percent return is much higher, if that makes sense. Another level that's come in, and it's common in some deals. Some people really haven't seen it. And the reason it's important to understand this preferred equity position is because in some cases today, for properties that are existing, let's say there's a syndication that already has an asset, it's operating, and they're running into issues, whether it be through lending or other areas of profitability, and they need additional capital. There are syndications today that are seeking a preferred equity position to come in, even though the deal's already closed and they're years from the original closing, but they're looking at their projection of the future and they think that they can stabilize themselves with a little more capital. Now, it's not all the time, but sometimes because of a series of decisions that have been made and opportunities that have been presented to people, sometimes this comes in later. The most common situation is that before closing, and as you're looking at the deal, you understand we've got this much debt. If you have a mezzanine, debt in there, then you have that shown in the pro forma, if you will, and the private placement memorandum, everything. And then if you have a preferred equity partner, you're going to see that, or you're going to hear from the sponsor that you have this position in there. And what does it really mean is, in effect, you've split that equity into two groups, right? So you've got your common equity, which is your, let's say, traditional investor like us. And then you've got this preferred equity position, which, can sometimes be institutional or just private equity in general. But when they come in, they typically are in a position in line in the capital stack where they are going to get paid first, right? Now, whatever their returns are is what they are, right? It's typically negotiated, but it can be anywhere from 10 to 14%. So if you think about it, the income coming in, it's going to pay your debt, whatever debt structure you have. And then after that, it's going to go to the equity partners. And if one of those equity partners is a preferred equity position, they're going to get paid first prior to any other investors. And if you think about that, some deals today, and this is why it's important, some deals today are in a place where if the deal itself is cash flowing, that's great, but a lot of that cash flow is squeezed today in such a way that the preferred equity partner is the only one getting paid. Yeah. And so if the preferred equity partner is the only one getting paid over the lifespan or over most of the life of the project, then that could be a deal breaker for some people. So it's important to understand. Some people, they don't care. They care about the total returns, and that's what's most important to them. But this preferred equity position, that's what's happening with that. It's kind of like a preferred return for a specific equity group is another way to look at it. So in general, there's common equity and then there's preferred equity. These are our equity partners. All of them get paid after any debt, obviously. And then, of course, I would talk about benefits and risk. And then I'm going to talk about a special case that someone had a conversation with me about recently that people should be aware of at least. So in the capital stack, there's benefits and risks, of course, right? So the benefits of senior debt is they get paid, right? If anybody's getting paid, they're getting paid. At the common equity, the benefit is really in the higher returns. They're in that highest return bracket. And this is for people that really want those higher returns, right? They don't want to be the debt partner because they want more than 6 to 8%, right? They want the highest returns possible, so they're coming in at the LP position, if you will. But because of that additional risk, they're also expecting higher returns. And to be honest, the benefits in that is you're in the best position to get the most returns you can. But in most cases, if you have moderate leverage or even if the property is kind of underperforming, people in this class can reasonably expect to not lose their capital, right? In most situations today. The risks come in where you see in some properties, right, where they're significantly underperforming. In those properties, yeah, there's a potential to lose capital, right? That's a risk. Or if you go into bankruptcy and you're restructuring the loan or you're bringing in other debt, or even if you're restructuring the classes of investors to open up new capital, that's where the risks can come in for some early investors. But in general, most people would say, hey, it's still a fairly, good position to be in. One, because of the returns, and two, it's still very unlikely you're going to lose that capital. Now, where it comes in is in a property, and I would say this is more the exception to the rule than the rule itself, right? Or the expectation itself. These are more exceptional circumstances, would be if there's a property that's really underperforming, right? Then we get into this whole restructuring idea, right? And this is for a property that is already existing. They've run into issues, whether it be some of the renewals they have to do, or the expenses have gone significantly up, or they had a variable interest rate on their loan, and that's now grown, or maybe they have a cap on that interest rate on the loan, and that's, in some cases gone up by 20x, as we discussed, previously. There's significant issues that a property would have to go through to hit the level of underperforming that would require someone, from a business purpose to restructure the whole deal. Now, if they have to do that, there's only a few places they can go, right? They can go to new capital from existing investors. That's kind of stop number one, if you will, in the capital gain is, hey, we have existing investors. We need additional capital. We're going to go to them first, right? If for whatever reason those investors choose not to bring in this new capital, right? They can also do things like member loans. They can do other external loans, or they can bring in preferred equity. And there's a lot of other ways to, let's say, save the property, right? But if you're in this property saving mode, you've checked off a lot of these easy things to do, if you will, not preferred things to do, but easier to do, and bring in a separate equity. So preferred equity is coming in as a new class, then I would say it's going to be a big challenge for those initial investors to make the returns that they were originally projected. And the primary reason is that, number one, the debt's going to get paid first, right? And number two, this preferred equity position's coming in at a lower risk level, with new capital. compared to that original investor base. And so they're going to get paid first, right? So if they're coming in and expecting a 12% or a 14% return, then both the income and the profits of the property have to pay that first before distributions are going to go out to other investors, right? So that's the piece that some people kind of miss out on in understanding, especially if someone's in very difficult times and they're going to have to restructure. It's important to understand because you might just see it as, well, I don't want to participate in the capital call, as an example. If a property is underperforming and there is the unfortunate event of having a capital call, some investors may choose not to participate in that for whatever reasons there may be, but understand that for that property to perform and for the business to succeed and save the overall asset and the entity, the sponsors may be put into a position where they have to bring in other partners, right? And if they have to do that, then you now understand, kind of the structure of what might be expected, right? You might be pushing yourself inadvertently into a position of not making the same profits that you would have expected to before because you have someone that's getting paid first. I would say first commandment of the capital stack is know thy place in line, whether it's the very traditional style of common equity, senior debt. Common equity is getting paid second, right? Senior debt first. And because of the higher risk of the passive investors in the common equity, they're expecting much higher returns, right? Now, if you have any number of other players involved in between that common equity and senior debt, it means, okay, we have a smaller percentage of common equity. So we should expect even higher returns. But at the same time, the risk that we're accepting with that is that everyone else is getting paid first. And so if the property performs as expected, there's no issues. If the property underperforms, then that might mean that I'm definitely not making my projected returns. Yeah. And so those are the risks that we need to be aware of. We're going to jump into some Q&A here in a minute. Before we do, I just wanted to say we do have our next opportunity already put on the calendar. It's for November 29th, and it's going to be at 12 p.m. again. On November 29th, and we're going to talk all things taxes for people that invest in real estate. So this is the place to be if you've got those tax questions, but you're just not certain what they mean, or you're new to passive investing and you're trying to get your head around, well, I've heard there's great tax advantages, but is that relevant to me, right? Or how do they benefit me as a passive investor? Then this is going to be the place to go. Additionally, we do have a preferred investor list that's out there for people, and this is really for people that are ready to move their capital now. So we may reach out to them even before we have a signed contract. We might have something in an LOI or something like this. We may even reach out that early on simply because we want to have conversations with people that are ready to move. And so there's a handful of people that we have in there. It is limited to that list, right? It's not going to be, we're not going to expand that enormously, but we do have a handful of people that are already in there and getting that early look into things. And so if that's interesting to you, certainly reach out to me via email or, you know how to get in touch with me. And then beyond that, we do have live opportunities that come in from time to time, and most people don't realize, but we may look at 80 to 100 deals before we find one that we're going to bring to investors. So there's a lot of activity always going on in the back end. The thing is, though, is that only people that are in our investing community are seeing this. And so if that's interesting to you, even if you're just kind of new to the game, but you want to be a fly on the wall and see what these deals kind of look like, or be able to participate in some of the deal webinars and just get a feel for what's going on, I'd say go ahead and you can scan the QR code, or I've made it easy for you if you go to investwithbrady.com. There's a quick form there. It's an investor form. It's super simple questions that you can get through there. But at the end of that, my point is at the end of that, it's going to pull up an opportunity for you to set up a meeting with me. Yeah. So we can jump on Zoom, grab a coffee. Happy to answer any and all your questions related to investing, and including it will also give you access to those investment opportunities that we have over time. Yeah. So with that, I do want to jump into Q&A. And I see there's one question in here. Is this where a capital call position may come in, preferred equity? Let me go back up, David. So let's say you were in this scenario here that's on the screen, right? Where you just have senior debt and common equity. The first place a capital call is going to go is to the existing people in the deal. That's what the capital call really is. The reason you're going to do that is to save the property, right? And so there may be other reasons. Let's say that's the most common, right? And so they're going to come in here, and what they're going to do is they're going to say, hey, to get this property to survive, we've had these unexpected situations come up. We believe we need $1 million in capital to get the property to survive until we can perhaps refinance. Whatever that reason might be, they'll disclose that, but that capital call is going to go to those existing members in the deal. And the place that the common equity comes in, or the preferred equity comes in, that would probably be, hey, we've already gone out to new investors. Yeah, now we're going to open it up to outside investors. That's where that squeeze comes in that I was trying to show here, right? So this pushing in of new equity into the deal really is a scenario where the original capital call, for whatever reason, the sponsor may not have raised enough from their internal members, and therefore the next best is to go to external people. And one of those external people can be a preferred equity partner. Now, if they're going to do that, of course, there's going to be an extended webinar. There's going to be an extended discussion amongst the members, especially if they're creating a new equity class to come in, right? If they're going to create a class C, member class in the deal, right? They're going to have to go through the legal paperwork. They're going to have to go through the investors. They're going to have to go through the scenarios that's in their operating agreement. But it is possible. And the point is, I know people that have had to do this for good reasons. I know good operators that have had to do this. And the unfortunate scenario for the investor is that they're now in a position in line in front of you, right? They're going to get paid first, and then any additional proceeds will come in. And so even if that preferred equity, or let's say additional class of investors that brings in additional capital comes in, if the deal is still a solid deal and it's going to hit good returns in the future, that's great. Did that answer your question?
Yep. Curious where it came into play. So that's great.
Yeah. So the scenario that I saw it come into, David, was they were having to restructure their debt because of lending issues.
Uh-huh.
To do that, they had to do a capital call. They went to their investors first. After that capital call came member loans, which is people in the deal, right? Memberships in the entity. And then their next step is opening a new investor class, right? And that new investor class for them is just new investors in general, right? But it's a strong preferred return, right? Because they're trying to attract new people in. And because they're trying to attract that new capital in, they're going to offer them that security of after debt, you're getting paid, right? Now, overall, as long as that business plan works, right, and there's a strong belief that it would work, then the risk is a little different, right? If the project itself is on shaky ground, then that's where it draws a lot of question as to, is this the right business plan, or is the right business plan to sell the property? And those are discussions that people should have with their sponsor. With that, any other questions, Dave, from your side?
No, that was great.
Like we do have the next one already planned. We're going to talk about taxes. I've gotten a lot of questions as of lately on taxes. So I'm inviting in our CPA that's going to cover taxes for people that invest in real estate, right? Specifically focused on the passive investors, since that's really who we're trying to cater towards. But again, that idea of, how can investing in real estate, especially investing passively in real estate, help us in our taxes, or at least what should we expect? I know it's right around the corner from Thanksgiving, but I'm hoping it's still an appropriate time of year, at least, to get those questions answered before we jump into the new year. Thanks everyone for attending. Thanks for the questions there, David. Until next time, I hope everybody takes another step forward in their journey there, and we'll talk soon.